You're listening to Seattle Real Estate Podcast.
Maybe you or your clients are looking at doing a refinance. Maybe you are looking at purchasing a home, or your clients are purchasing a home. Take advantage of the historically low interest rates we have going on right now. Don't wait. Jump in now. Here's why. That's what we're going to cover on this episode of the Seattle Real Estate Podcast. So let's jump on into it. All right, so I'm checking out an article that I think covers this topic really well for right now. Today, we are June 19th, 2020, and it's from MarketWatch, and it is Mortgage Rates Drop to Another Record Low. Here's why Americans may not want to wait too much longer before locking rates in. So get on it, people. Get those low interest rates. Low mortgage rates are stoking the housing market's recovery from the coronavirus, but there may be limits to how much of a boost they will give. Yep, we kind of know that. All right, so mortgage rates have fallen to a new all-time low for the fourth time this year, and we're already in June. But there's significant upside risk to the low rate environment, and Americans may not want to wait too much longer before locking rates in. That's kind of what I'm saying too, is don't wait too much longer. Don't wait any more at all. Jump in now. The 30-year fixed-rate mortgages averaged 3.13% for the week ending June 18th, down 8 basis points from a week earlier, and that's from Freddie Mac. They reported that yesterday, Thursday, June the 18th. The previous record low was 3.15% back at the end of May. A year ago, the 30-year home loan averaged 3.84%. So we're getting close to a full point lower where we are right now today. And that's basically the point here, is that rates can't go that much lower. The Federal Reserve has committed to keeping the low interest rate environment through 2022. That's a long time. Now, they're going to bounce around a little bit, maybe go a little bit lower, but we could go higher. And that's why, if you can take advantage of something right around 3% or the 3.15%, that we're talking here, 3.13%, that is an amazing interest rate. Take that and run. Don't risk trying to get another quarter point lower, because I don't think they're going to go much lower than like 2.75. We've got resistance typically at 3%. I don't see it going a ton lower than that. And let's be honest, if you're trying to wait for a 2.5% interest rate, you are just being greedy. So take your 3.15% rate, take your 3.25% rate, and say thank you, go to the bank, close your loan. Obviously, that's an oversimplification, because it's a long process to get a mortgage rate, to get a mortgage loan. But if you've got the shot, if you've got the opportunity, if you've got the credit to do it right now, I say do it, because people who wait, they might be sorry. And it's like, well, I'm just going to wait around to see what happens. Good luck with that. Seen this happen so many times, and people are like, I missed out. I'll be standing on somebody's front porch doing an appraisal for refinance, and they're like, yeah, I missed it 3 weeks ago, and I'm just going to go ahead and do it now because I'm tired of waiting. My luck isn't very good with trying to time the interest rates. And interest rates bottom out in a super narrow time window. They only usually happen for maybe a couple of hours, or maybe a day, maybe a couple of days is their trough, but it's not very long. And unless you are following the rates, and unless your mortgage guy is fully on board with you pulling the trigger right now today, he may not be letting you know. He may have a bunch of clients in his pipeline, and he can't get to everybody. So take whatever rate you can that's right around 3% or 3.15% and run with that. All right, the 15-year fixed rate mortgage dropped 4 basis points to an average of 2.58%. That is low. Get that if you can. If you're in the market for a 15-year, the 5-year Treasury indexed hybrid adjustable rate mortgage dipped 1 basis point to 3.09%. So that is what, these are all just crazy, crazy low rates. Mortgage rates have hit yet another record low due to the declining inflationary pressures, putting many home buyers in the buying mood. That's Freddie Mac's chief economist, Sam Cater, said in a recent report. The interest rates on home loans roughly track the direction of long-term bond yields, including the 10-year Treasury note. We look at the 10-year Treasury note all the time just to see, hey, what's going on? The 10-year Treasury yield was 0.698%, so just about 0.7%. That's seesawed over the past week in response to weakness in the stock market, driven by concerns about the rise in coronavirus infections across many parts of the country. Let's talk about that for a second. So when we see the rise in the coronavirus, People are freaked out, and they're like, oh my gosh, are we going to have a second coming of the coronavirus? And you can go all kinds of different directions there, but its impact is when we see the rising infection rate, the impact it has is the stock market kind of goes into this shutdown mentality. You saw how wildly the gyrations were at the beginning of the coronavirus back in January, that we had some massive downward runs. So everybody goes out of equities and puts their money into bonds, which have an effect of dropping the interest rates. More people dump money into bonds. More people are buying bonds. The yields drop because you've got more pressure on pricing. And so when you have lower interest rates, that's usually a reflection of the market softening. And so what could happen is the next thing, and that is upticks in coronavirus. We're still on the coronavirus cases. Upticks in coronavirus cases across the country left market participants skeptical of the economic recovery sustainability. Can we keep kind of climbing out of the hole we're in, is what we're saying. And that's by Matthew Speakerman, an economist with Zillow. This sparked a sell-off in stocks and a flight to the safe haven of bonds. Okay, we're jumping out of the stock market because maybe this economic recovery isn't going to be so great if the coronavirus keeps kind of ticking up as far as the infection rate. But we don't seem to be seeing a huge uptick in the death rate, do we? We don't see hospitals being tapped out. We don't see a ton of people on ventilators. We're strictly talking about the uptick in infection rate, and we're doing a lot more testing now, aren't we? So are those cause and effect? I don't know, but people are focused on the infection rate numbers, and that's what's kind of having some impact on some of our economics. And so this sparked a sell-off in stocks and a flight to the safe haven of bonds, something that normally pushes mortgage rates lower. So if you got a bad economy, your mortgage rates are going to be better. If you got a good economy and we're reopening and things are looking better, unemployment numbers are down, you're going to see an uptick in interest rates. And here we go. Rates could just as easily begin to trend upward again, particularly if key economic data or measures to contain or treat the virus show meaningful improvements. So let's look at that. So key economic data, if you have some economic data releases in the next week or two that are really positive, you're going to see mortgage rates go up. So is that a likelihood? I think so. Yeah, I do. And a lot of times that data gets released and then they revise it. It's not as great as they thought, but the impact on mortgage rates has already happened. So good economic data or measures to contain or treat the virus show meaningful improvements. Well, they're not going to talk about non-meaningful improvements, are they? That's not going to hit the media. All this stuff behind the scenes is happening. And have they had coronavirus treatments that haven't worked out? Yeah, we've had a ton. But those don't get a ton of news coverage. If you have one or two, positive news stories, that is going to have an impact on interest rates for sure. So here we go. But now the mortgage market is at a turning point, Speakerman said, and it all depends on what happens with the spread of the COVID-19 from here on out. That's true. That's a true statement. That is one factor, but there's a lot of other economic factors kind of going on as well, not just COVID-19. Rates going up could spell trouble for the broader housing market. Eager to lock in cheap financing, buyers have flocked to apply for home loans to purchase property. There's evidence that low rates coupled with pent-up demand caused by the coronavirus stay-at-home orders is driving a significant recovery across the housing market. We are really seeing that here in the Seattle market. I think you've got some good weather cut here in early summer. You've got historically low interest rates, and you've got historically low supply of housing. There's so few homes to look at, especially in big tract neighborhoods that have a lot of demand. You've got nothing. And as soon as something comes on the market, it's either sold or it's sold with multiple offers on the review date. And so we're seeing that. People are talking about, your CHAZ or your CHOP situation. It's going to have a huge downward pressure on property values. You don't know the property market, Sean. You just don't know what you're talking about. And I'm like, hey, interest rates are super low. You've got no inventory. You got a ton of buyers out there. That's what's going on. The immediate areas surrounding CHAZ, yeah, that'll be impacted. It's hard to sell a condo in those markets for sure. But is CHAZ a permanent thing? No, it's here for a few weeks, a couple of months, maybe till the end of summer, or till somebody comes in and closes it down and clears all the protesters out, something along those lines. I mean, I don't see that autonomous zone being a permanent reality in there. And even if that does happen for some crazy, wild reason, the areas outside of it, I don't think are going to have that much of an impact. They're going to be like, yeah, the Chaz zone's a few blocks over that way, but they kind of stick to themselves and whatever. And so who knows? But the area itself, the immediate area, is probably going to have some impact. But the greater Seattle market, it's not going to be impacted. It's just not. It's not happening. The data right now is saying otherwise, because I look at it and like, yeah, it'd be hard to sell a condo in that immediate zone, the Chaz zone. But it's only like a 5-block radius out of a city of millions of people. So, all right. So back to the article here. An increase in rates would hamper the housing market's ability to rebound, but it's not the only headwind the market is facing. It would be difficult to sustain the momentum in demand as unsold inventory was at near record lows coming into the pandemic, and it has only dropped since then. This is what Cater said. In other words, with very few homes for sale, there's a rather low ceiling on how high sales activity can go for the foreseeable future. And we're seeing that a ton, is that we don't have enough inventory for all the buyers. And so we just don't have a ton of rotation. We don't have a ton of activity. So all the sales numbers are going to be down as far as housing goes. And the media will glom onto that. But in reality, prices are being driven up because you just don't have enough supply for all the demand that's out there. And so you're going to see news stories here as we hit the end of June that'll say housing sales down dramatically. Well, yeah, it's because we don't have the supply. It's not because buyers are out there. The buyers just don't have enough homes to look at. So that's essentially it. My recommendation for people is that if you are in the market for housing right now, if you're looking to buy, get out there and buy. Get that rate, get that lock going. Get your mortgage in place so you can pull the trigger on a house if you can find one. If you're in a market that's got plentiful housing, I would say don't wait for rates to drop much lower because they're already at 3%. How much lower can they go? And the difference between 2% and 3%, yeah, it'll have some impact, but figure it out the other way. But difference between 3% and 4%, and that's what you risk. So take your low 3% interest rate to the bank and get it closed. That's my recommendation here. And I think you'll hear a lot of mortgage loan officers say the same thing. They may say, hey, depending on what your tolerance for risk is, you might want to see if you can get something a little bit lower. But then that flip side is that you're risking getting some historically low rates. Things might bump up because none of us really saw the coronavirus coming. I mean, truly, did we? The way that it happened, where we shut down the economy, nobody saw that happening. So you could have something opposite of that that drives interest rates up, and then you'll be, Tristan, take out this part, but hit it here. And then you'll be just kicking yourself for not getting that great interest rate that you could take advantage of right now today. So that's it from me. If you find this content helpful to your real estate investing, maybe your real estate career, or you're just a homeowner and you thought this was good to know and it was great content, love to have you subscribe to our YouTube channel, download us on the podcast channels. Appreciate all the support. Hit like for this video, hit the notification bell so that each time we put out content, which right now is daily, Monday through Friday, you'll be notified that we've got a new video out and you can check it out. So again, I'm Sean Reynolds from Summit Properties Northwest, Reynolds & Klein Appraisal. Thank you so much for watching this video or listening to it on the podcast platform. I will catch you in the next one. See you then. Bye. Don't forget to subscribe to our channel and hit the notification bell so you'll know when our next video is out.